Good afternoon, and everyone, as we're at the end of another week of trading on Friday, the 2nd of February. We'll have a flick across the calendar, then on to markets, and we'll see what is up and what is down. We started the week with GDP figures out of the Eurozone. Now, they have managed to avoid a technical recession, certainly along with the in line with the flash figures. Obviously, they're flash figures at the first estimate. They're not the final figures, which are the real figures when they do come out, but ultimately they're not going to be too far off, and if these flash figures are to go by, they will have avoided a technical recession in the Eurozone. Now, minus 0.1% was expected. 2 consecutive quarters of minus 0.1% is exact. It's not exactly the deepest of recessions, is it? Markets will be more. They will watch with more intent the actual figures on a day-to-day basis rather than those kind of GDP figures. They're pretty backwards looking already in February, and those are Q4 figures, so I wouldn't worry too much about that. I wouldn't read into too much about that. Markets will sit and wait for when they are going to get that first cut from the ECB. Do we get it March, April, May? Different people have different opinions on it. They're all awaiting a wage data that comes out in May for Q1. They seem to want that, but ultimately they are probably going to be the first of the major central banks to cut rates, I think, certainly out of the G8 central banks, or the central banks of the G8 currencies. Apart from that, you got the Fed then on Wednesday. The Fed, the Bank of England, and then non-farm payrolls today, the main focuses of attention this week. The Fed, not changing interest rates. That was to be expected. Absolutely no chance they were going to cut interest rates at this meeting. Right. The next meeting, March, they have pushed back on that, saying that we're not going to get an interest rate cut in March. I think that was pretty easy to guess. I mean, certainly from my point of view, markets were a bit kind of trying to tell the Fed that you're going to cut in March. That's not likely to happen, especially after NFP today. They're going to blow out jobs figures, but we'll have a look at that now in a minute. They do suggest that if any, that risks to the upside inflation do still remain, although more balanced, but they do still remain. If anything happens to jeopardize, inflation back to that 2% target, they are ready to hike interest rates further if needed. Are they going to need to do that? No, but are ready to tighten if needed. But they did. I did remove a part of the statement. If I flick into this, I can't remember the exact words off the top of my head, but Chair Powell said it was appropriate to begin reducing rates sometime this year, but Fed removed further reference to further rate hikes from the statement. So they did reference that further rate hikes are a possibility. They have removed that reference, but they still do leave in that they are prepared to tighten policy further if needed, if anything happens to jeopardize inflation back to 2%, which I can't imagine anything of that sort happens anytime soon. The Bank of England, then again, the Bank of England, I'm started talking about interest rate cuts, have opened the door to interest rate cuts, but ultimately upside risks to inflation still remain. Inflation is still too high above the target, and they do need to keep policy at a sufficiently restrictive level for some time yet. No signs of an interest rate cut anytime soon from the Bank of England, and that is likely to prove supportive for sterling going forward. Maybe not against the US dollar, but sterling upside, as I've spoken about for a number of weeks now, a number of months, going back towards the back end of last year. I do think upside on sterling is not a bad bet when you take into consideration that they will probably not be cutting that interest rate anytime soon. Certainly, I think one of the last of the G8 central banks to go on hike or cut interest rates, should I say. Non-farm payrolls then comes in today. Pretty, blowout jobs figures, upwards revision to the previous figures as well, but consensus 180k, actual 353, and then previous was upped by about 100k as well. So 353,000 jobs added to the US economy certainly is not signs of a slowing down labour market by any stretch of the imagination. The unemployment rate stays firm at 3.7%, but below consensus, so also a beat on that. You look at average hourly earnings, they are up month over month and year over year, both up on previous and consensus, and again both up on previous and up on consensus. So at the end of the day, positive job figures completely removes the need for a hike completely removes the need for a cut in March, should I say. Markets will begin then pricing in a full cut for May, but ultimately, unless the economic data takes a sour turn, there's no real need for it in May. And markets had priced in back end of last year a total of 6 interest rate cuts throughout this year. The economic data does not line up suggesting that anything is going to be different from what the Fed suggested to us, 3 interest rate cuts throughout the course of this year. So there's not much apart from that to really say. I mean, the Fed, dovish or hawkish, and they're kind of neutral. There's a bit of nothing then on Wednesday. The Bank of England did drop reference to further hikes. I mean, both central banks dropping references to further hikes, but Bank of England somewhat opening the door to rate cuts. They say that it is possible at some point this year, but it doesn't take a genius to figure that out, does it? So at the end of the day, Bank of England, I think we've got to, with both of them, we've got to go off our own opinions rather than anything new that they told us over the past couple of days. And obviously non-farm payrolls likely to keep the US dollar underpinned, certainly in the near term. As you can see, a bit of dollar strength post-Fed on Wednesday, then weakness yesterday and strength in today. And the dollar gone through the roof post-NFP. I mean, you look at some of these, post-NFP, nearly 100 pip move lower from the highs to the lows today in euro dollar. Same thing across Aussie, Kiwi, euro and sterling. Upside against dollar Swiss, dollar CAD, dollar yen, and obviously the dollar index equity downside across the board as well. Not been absolutely hammered, but downside across your S&P, your Dow Jones, your Nasdaq and your Russell. Back into solid gains yesterday. I mean, massive upside yesterday. Meta, strong earnings. Extremely strong earnings from Meta, strong earnings from Apple last night, causing solid upside in stocks. That is being reversed at the minute, but I struggle to see. I struggle to see a way stocks go too far lower. I mean, it kind of just reinforces the soft landing narrative, and with companies still performing well, certainly in the tech sector, Nasdaq hasn't sold off too much, and it's pushing back to the highs. Judging by the way recent data releases have gone, I mean, it would absolutely not surprise me whatsoever to see stocks back towards the highs come the end of the day. So how stocks react to this over the rest of the day, I'm not really too sure, if I'm being perfectly honest with you. I think coming into the close today, if stocks do rally and go back towards the highs, I'm pretty sure that tells you what way we need to think next week. If stocks sell off further than what they already have done into the close today, that would be an interesting one, but I don't know. I think markets just don't want to sell stocks. I think they just don't care what the Fed have to say or what the economic data says. Until the economic data takes a sour turn, I still think risk assets remain supported. And what does that mean for the US dollar? I mean, it's no surprise that the US dollar is ripping higher off the back of those NFP prints, completely putting paid to any thoughts of any interest rate cuts in March. But ultimately, at the end of the day, you can still see a situation where the US dollar rallies, stocks rally, and also yields rally as well, just off the back of positivity surrounding a soft landing. So, be interesting to see how markets close today. Oil continues its move lower. No massive drivers in the price of oil. This pushing lower, but the Middle Eastern tensions not really having an effect in markets. We were having a look earlier on this week about a potential move lower. That is what we've got. Markets have moved lower. I mean, is there massive reasons for oil to continue moving lower? I mean, it's not quite, is there? But at the end of the day, the market will do what it wants to do. It's been trending up for a while. It's giving back some of those gains at the moment. Ultimately, this move higher was driven off the back of tensions in the Middle East. But I say tensions in the Middle East. Is it really tensions in the Middle East? I mean, they probably came out the wrong way. Obviously, there's tensions in the Middle East, but does it really affect the price of oil that much? If a couple of oil tankers get hit, and they can just take a different route, can they? And ultimately, production of oil continues to be the same. It's just whether global demand can keep up for it. So we'll keep an eye on that as we head into next week. But what we think about next week, I'll make that decision on Monday. Let's see how stocks close up for the evening. But economic data for the rest of the day, some Michigan consumer sentiment figures at 3 o'clock. Wouldn't pay too much attention to that into next week. Then a few things out next week, but we will cross that bridge when it comes to it. But interesting moves post NFP. Dollars down, then up, then down, up, then down, then up, should I say. Equities down, then up, then down. Pretty choppy week, a volatile choppy week. Let's see how markets close this evening and see if we can make some cash again next week.